Welcome to Gurukul Live Lectures. I am Dr. Divya Verma Gakhar. I am Assistant Professor in Guru Gobind Singh Indraprasth University, University School of Management Studies. My area of specialization is finance, and in the series of lectures, I am going to start a new subject called Financial Markets and Institutions. In this subject is related to financial markets and institutions in India. It's a very basic subject which is very useful for BBA and MBA and BCom commerce students, because they have to have an understanding of financial markets and the Indian financial system as a whole. So, basically this subject is going to include various lectures related to the financial markets, which include banking sector, which includes capital market, the primary market, bond market, derivatives market, and all other financial markets and services which exist. Apart from that, we will talk about various financial institutions, we will talk about various financial instruments and financial services which are very popular nowadays, like NBFCs, like mutual fund companies, insurance companies, and all of us in our day to day life are associated with the financial system in one way or the other. Because as a individual, as a student of finance, as a student of commerce, we need to understand the financial markets, we need to understand the financial system, and we also need to know all this because we have to invest our own money as well. So, today is the first lecture in this, and we are going to, it's an introductory lecture where we are going to talk about the Indian financial system. So, financial services industry is largest in the world, and increased global attention was drawn on the financial service sector due to the impact of global financial crisis, recent Eurozone crisis, and the UK Brexit issue on the economies of many countries. The global financial sector has undergone a turbulent period because of bankruptcies and liquidity problems in many countries. Failure of banks and financial institutions have raised serious questions about the stability of financial system. India is one of the fastest growing economy in the world, and the contribution of service sector to GDP of the economy is gradually increasing, whereas the contribution from other sectors has declined. As per the Economic Survey of 2016, the Government of India, the service sector has emerged as the most dynamic sector globally and is key driver to India's economic growth. Economic growth of any country depends on wide range of activities like hotel and restaurant industry, trade, transport, storage, communication, financing, insurance, real estate, business services, construction services, etc. The service sector contributes among almost 62% to the gross value added in 2015 and 16. This sector is a net foreign exchange earner in India and is considered as the most attractive sector for foreign direct investment inflows as well. Talking about Indian financial system consists of financial markets and financial institutions. In financial markets, people buy and sell financial instruments like shares, bonds, future contracts. Financial markets can be informal and they can be highly organized market like gold market or other institutional framework which exist. Financial institutions are firms such as commercial banks, credit union, insurance companies, pension funds, mutual funds, finance companies that provide financial services, consultancy, advice to consumer, businesses and government units. The distinguishing factor of these firms is that they invest their funds in the financial assets such as business, loan, stock, bonds, rather than real estate such as manufacturing facilities and creating equipment. Banks and other depository institutions such as insurance companies, they gather money from customers in small denomination, aggregate it and then make loans in bigger denomination. So, savings from small consumers in small denominations are the origin of the bigger larger pool which these banks and financial institutions create, and they use it for providing loans to those people who actually need money at any point of time. An important function of the financial system is to allocate money to the most productive investment projects in the economy. If financial system of any country is working properly, only projects with high risk adjusted rate of returns should be funded. Banks are profit making organizations. Bank and other lenders earn much of their profits from spread between lending and borrowing rates which they have. Now, there are various economic units in an economy. All these economic units can be classified into basically four groups. One is household, business firms, governments and foreign investors. Each unit has different income source and spending pattern. Each economic unit must operate within a budget constraint imposed by the unit's total income for the period. An economic unit can have any of the three budget positions. There can be a balanced budget where income is equal to the expenditure. There can be a surplus budget where your income is higher than the expenditure which you have incurred, and these units can lend funds to other units through the financial institutions. So, they are known as surplus spending units. There can be a deficit budget unit where expenses are more than the income, and these economic units need extra funds. So, from where they can get this extra fund? They can get it from the surplus units who have that extra fund, and they are known as deficit spending units. So, households are basically principal surplus spending units, but some businesses, states and local government and foreign investors periodically run surplus budgets. Businesses are principally deficit spending units in the economy, followed by federal government, but household, state and local government and foreign investors at times borrow money to finance their purchases. So, flow of fund through the financial system happens in two ways. One is direct financing and other is indirect financing. So, fund flow can flow through financial markets, that is direct financing, and indirect financing is that fund is flowing indirectly through the financial institution in the financial intermediation market. Now, financial intermediaries are middlemen that facilitates transaction between surplus spending unit and deficit spending units. Regardless of the financial method, the goal is to bring the parties together within the least possible cost and with least inconveniences. An efficient financial system is important because it ensures adequate capital formation for the economic growth of the country. If financial system works properly, firms with most promising investment opportunities, they receive funds, and consumers who can pay at the current market rate of interest can purchase cars, home on credit and take loans for other purposes as well. Now, if you see this graph where the flow of fund is shown through the financial system, so there is direct financing which is happening where the surplus unit is giving the funds through financial markets to the deficit spending units, and then there is indirect financing where financial intermediation market surplus gives funds to the financial intermediation market, and financial intermediaries they give funds to the deficit spending units. For example, let us say Reliance Industries needs 500 crores to build a new manufacturing facility, and they decided to fund by selling long term bonds with 15 years of maturity. And let us say that Reliance contact a group of insurance companies which have expressed an interest in buying Reliance bonds. So, the insurance company will buy the bonds only after determining that they are sound investment and are priced fairly to the credit risk. Likewise, Reliance will sell its bonds to the insurance company only after shopping the market to be sure that they have got a fair deal. Now, talking about the financial system, it is an institutional framework existing in a country to enable financial transactions in an economy. It has basically four components. Component 1 is financial institutions, financial markets, financial instruments and financial services. Now, financial institutions includes banks, mutual funds, insurance companies, etc. Regulation is another part of the financial institutions because we have various regulatory bodies like RBI, which governs the banking sector. We have SEBI, Security Exchange Board of India, which governs the stock exchanges. We have IRDA, Insurance Regulatory Development Authority, which is governing the insurance sector. We have the mutual fund MFI. We have Association of Mutual Funds of India. So, they are governing the mutual fund industry. And then there are financial markets which include capital market, money market, forex market, derivative market and other such markets. Third component is financial assets, which includes loans, deposits, bonds, equities, etc. And fourth component, very important, of financial system of any country includes merchant banking, that is the financial services, which includes merchant banking, factoring, housing finance and other such financial service industry which do not offer any product, but they offer services which can be fee based services or fund based services. So, basically in the structure of Indian financial system, we have institutions, markets, services and regulators. So, financial institutions include banking institutions, insurance and housing finance institution, non-banking financial companies and mutual funds. So, banking sector itself is very big. There are scheduled commercial bank, non-scheduled commercial bank, cooperative banks, regional rural banks, foreign banks. Under the scheduled commercial banks, they are classified as public sector banks and private sector banks, and they can be studied in detail, and we will talk about these in some future lectures. Then there are non-banking financial companies, so which include NBFCs, discount finance industries. Then there are mutual fund companies. So, all the institutions which are related, which are dealing in the business of money or matters related to money and are not offering any product or services or are manufacturing something, they are known as financial, they would be a part of the financial system of an economy. So, under the financial markets, we have broadly capital market, money market. In the capital market, it is further classified as primary market and secondary market. Another way of classifying the capital market is equity market, debt market and derivative market, which is a market of futures and options, where the futures and options of stocks which are being traded are dealt with. So, that is the derivative market. In the equity market, we have primary market, where public issues, initial public offers, and any place where first time shares are issued, they come under the primary market. Then we have secondary market. In secondary market, we are dealing with existing shares of companies which are being traded in the stock exchanges. So, earlier it was a monopoly kind of system where there was only one single stock exchange, that was Bombay Stock Exchange, but later on after 1995 there are a few more stock exchanges which have come up. NSE came in, then there are other stock exchanges which were corporatized and demutualized after certain time period, and very recently there are many stock exchanges which exist in India. Then in the debt market, there is corporate debt market and government securities market. Government securities market is majorly regulated by RBI, and there are instruments which are available in government securities market. Then there is corporate debt market, where the corporate who have to borrow money, they can borrow money through the corporate debt market. The size of corporate debt market in India is still not very large, and it is not very deep. That's a point of concern of the financial regulators right now. And in the money market, there are such instruments where which are to be traded within a period of 1 year. So, they have short term maturity instruments. So, there is call money, notice money, there are instruments like certificate of deposits, commercial papers, treasury bills. So, these are majorly governed by RBI, and all the central banks or all the commercial banks are participating in the money market instruments. Next comes the financial services. So, financial services includes depository services. Depository services are related to stock markets. So, there are depositories who are keeping the actual form of shares in the form of electronic mode. So, we have Demat account through which we are able to transact the electronic copy of our stocks which we have. Then there are stock exchanges which are providing a platform to consumers, to investors to buy and sell shares. There is venture capital. So, venture capital are those firms who provide funds to the new ventures, who provide funding to the new businesses which are risky in nature, which do not get finances, and they do not have enough finances to get funding from anywhere. So, they get funding from these venture capitalists, whose main purpose is to boost up entrepreneurship in the country. Then there is securitization, where new kind of hybrid financial instruments are designed and by the investment banking or merchant banking firms, as we know. Merchant banking services are also very important nowadays, because they are related to all type of advisory and consultancy services which they provide to the corporate sector. So, these financial merchant capitalists or merchant banking firms, or also known as investment banking. So, they provide the services for public issue, they help in underwriting, they help in providing guarantee, they help in providing the project designing, and all these things related to the corporate advisory services. Another important financial service is credit rating agencies. So, these credit rating agencies, as you know, they provide rating to corporates, they provide rating to countries, to individuals to come to various financial instruments like bonds or any financial instruments which is being issued. So, credit rating has to be provided to it. So, some rating agencies like CRISIL, ICRA, CARE, Fitch, and there are other foreign players also, Moody's, Standard and Poor, who are playing an important role in the financial sector of the country. Next comes the regulators. So, these regulators are basically governing the financial markets and institutions and products overall. So, SEBI is the regulator for financial markets, where they are dealing with the capital markets and stock exchanges broadly. So, they are a watchdog, they are providing guidelines, they are designing framework, they are thinking about that how investors the investor benefits or investor is taken care of in terms of they are not cheated. And then there is RBI. So, RBI is central banking agency for the banking sector. So, they are giving the rules, regulations, guidelines related to how money has to flow related to the banks, and they also take care of the inflation, they also take care of the monetary policy which is designed by the for the government. Then there is Insurance Regulatory Development Authority of India, which is related to the insurance sector, which is regulating the insurance sector per se. Then there is PFDA, which is Provident Fund Development Authority. Ministry of Finance is there, Ministry of Corporate Affairs exist, which are also looking at that how corporates are reporting information, how companies are formed. They are giving guidelines related to corporate governance, Companies Act, and CSR and all other corporate related issues. So, MCA, Ministry of Finance, they are taking care of these things. Now, what is the function of a financial system of an economy? Financial system provides mechanism for mobilizing savings. A financial system has demander of funds in certain sectors and supplier of funds in certain other sectors. It channelizes the savings from surplus sector to the deficit sector. It provides a mechanism for storing wealth. It facilitates those investors to store their wealth in the form of financial instruments. They provide liquidity, so financial instruments can be converted into cash and vice versa via financial markets. They also provide credit mechanism. It is a it facilitates the process of extending credit through banking sector as well as through financial institutions to the households, business firms and government. They provide a payment system. It is a mechanism for making payments for goods and services like flow of funds from the banking system. So, through which we can make all the payments to anybody. They are related to risk management. They offer wide range of insurance products to manage life, health, property, income risk. Example, credit risk can be managed by banks and financial institutions. So, that is how risk management is an important function of financial markets. Financial markets also help in policy implementation. So, it becomes a framework for implementing policies for the government. So, a lot of government policies, they are implemented through the financial system of the country, like monetary policy, which is one measure of the government to control inflation. Financial system of the country also is an information provider. With the introduction of technology, price information is available on real time basis. So, they help the markets to become more efficient. Then comes the financial institutions. So, it includes institutions and mechanisms which affect the generation of savings by the community. They mobilize these savings and distribute these savings to all those people who have less of these, and so from the deficit surplus unit, it goes to the deficit unit. So, financial institutions include regulatory bodies and other intermediaries. These regulators include RBI, SEBI, IRDAI, FCI, IDBI, state finance corporations, which are governing at various levels these institutions and the whole system. Then there can be intermediaries, that can be banks and non-banking institutions, which include insurance companies, mutual funds, non-banking financial companies. Third comes the financial markets. So, it is referred to as those centers and arrangements which facilitates buying and selling of financial assets, claims and services. The term financial markets includes capital market, money market, foreign exchange market and derivative market. Financial markets help in determining the asset prices, as the buyers and sellers determine the price after an evaluation of risk and return on these securities. Thus, the prices reflect the risk return trade off and serve as means of ascertaining the value of securities. These markets are organized and unorganized. In the organized sector, we talk about banking sector, which is organized, which includes scheduled commercial banks, non-scheduled commercial bank, regional rural banks, and all other kind of banking system which exist. And the unorganized the unorganized market relates with those money lenders, those zimidars or chit funds which exist at the informal level in the country, which are also fund provider, because they have themselves surplus of fund and they can provide funds to those who are poor. And in that perspective also, nowadays government is very particular related to reaching to every corner of the country, reaching to every sector and every strata of the country through financial inclusion. So, like schemes like Jan Dhan Yojana, schemes like where government is trying everybody should open a bank account. So, a lot of new bank branches, virtual banking, and then single window transaction system which the banks have opened, and then they have opened ATMs at various village level, so that everybody should have access to the banking sector. And with this Jan Dhan Yojana, they have promised you can get insurance services, you can get banking services. So, financial inclusion is possible only through when the whole country is organized, is covered under that organized banking system. Then the poor people, or those people who are underprivileged, who are not getting all the facilities of the government, they get all those facilities through this Aadhaar and through their bank accounts. They get all the facilities which the government is providing them. So, it is very important for the overall development of the economy, and banking sector has a very important role to play, because those people who live in far-flung areas, or those people who lived in rural areas, or who are deprived, who do not have the literacy, who do not have the understanding, and they have to they are just they don't know when an emergency situation comes and from where they should get the money. So, they actually go to the money lenders or zimidars to borrow money to pay off their debts, and throughout life they are paying off their debts. So, if they know that there is a banking system which they are attached to, at least getting money, borrowing and lending, and the surplus deposit of the surplus fund will become easier for these people. Then thus this financial institution has a very important role to play. Then there are primary and secondary markets. So, the markets can also be classified as primary market and secondary market. So, primary markets are those markets where the funds are raised for the first time, when anybody comes up with a public issue, any corporate sector can come up with the public issue, government can issue certain bonds, securities, or some instruments. So, whenever any security is issued for the first time, it is known as in the primary market. And later on, the second part of the market is the secondary market. In the secondary market, the idea is that already existing shares or already existing securities changes hand. So, one can buy and sell these shares or securities or bonds or government investments by transferring it to the other person. So, that is also possible. That comes as a part of the secondary market. Then the markets are also classified as money market and capital market. So, money market are those markets which are related to investments in the short term fund, where the investment is made for less than period of less than 1 year. Then the second part of the market is the capital market. Capital market is where money is invested or the investments are made for a longer period of time, that is in the primary market or the stock market and the bond market, wherever the longer duration securities are available and the investment is made in those type of securities. So, these primary market is the market for new issues or the initial public offers. Stock exchanges, they constitute the secondary market for securities. The operation in the stock exchanges is governed by SEBI. Money market deals with short term instruments like interbank market, government securities market, commercial bill market. Futures and options contracts are also traded in derivatives market. So, derivative market is a market where we talk about investments which are virtual in nature, whose value is derived from some other instruments. So, their value can be derived from a stock, value can be derived from a commodity, from currency, from any foreign exchange or any gold or other instruments. So, now there are interest rate derivatives available, weather derivatives, energy derivatives. So, all these kind of hybrid instruments exist nowadays. So, these contracts, they derive their value from the underlying asset, which may be stocks, currencies or index numbers of stock market. And we are dealing in the derivative market by talking about that, we are investing in derivative products of, let us say, a stock which will be purchased after 3 months at a future price at a future date between two people, and the agreement is done today. So, at a future date, at a future price, whatever will be the actual price and the future price, the difference between the two will be the profit or loss which they will be, the two parties are going to exchange between them. So, they are known as future instruments or futures. Then when a company publicly sell new stock or bond for the first time, it does it in the primary market. And financial claims are initially sold by deficit spending units in primary market. People are more likely to purchase a primary financial claim if they believe that they will not hold it forever and until its maturity in case of bonds. And the secondary market is where securities are traded after company has sold all the stocks, bond offered in the primary market, and secondary market is like used car market. So, they let people exchange used or previously issued financial claims for cash at will. Secondary market provides liquidity to investors who own primary claims. And so, basically the financial markets, they deal with the primary and the secondary market, or they can be classified as a primary market and secondary market. They can be also classified as money market and capital market. While talking about types of financial markets, so financial markets can be classified as primary market and secondary market. They can be also classified as exchange and over the counter market. Once issued, a financial claim can be traded in the secondary market on an organized security exchange such as NSE. Trades made through an exchange are usually made on the floor of the exchange or through a computer system. Only members of the exchange may use the facilities, and only securities listed on the exchange may be traded. Securities which are not listed on an exchange are bought and sold on over the counter OTC market. The OTC market differs from the organized exchange market because the market has no central trading place. Instead, the investor can execute OTC transactions by visiting or telephoning an OTC dealer. So, all the over the counter bank related transactions, or if there is foreign exchange transactions which are done over the counter on a banking platform, they are a part of the OTC market. Role of financial markets is related to financial markets act as intermediary between savers and investors. They generate resources from investment and growth, allocate resources efficiently, improve the efficacy of the transmission mechanism of the monetary policy. Third component of the financial system is financial instruments. Financial instruments are those financial securities which are issued by the government, companies or local authorities. They represent the financial claim of investors on the issuers. These financial claims are known as the securities in the financial market. The term securities is defined under the Securities Contract Regulation Act 1956 to include mutual funds and derivative securities apart from the traditional securities such as shares and bonds. Now, what are the characteristics of securities? Securities are transferable, they have transferability. So, ownership of a financial instrument is transferable. This nature of transferability facilitates trading of securities in the stock exchanges. They have a particular term. So, financial instruments have different maturity period. Some are up to a period of very short period, some are up to 1 year, or they can be up to 5 years, 10 years, 3 years, or whatever time period. There is differences in the risk profile of various securities. Financial instruments have different risk return profile. For example, treasury bills are risk free, whereas equity shares are having very high risk. Financial instruments are structured instruments, so they are designed to suit the need of both the issuer and the investor. There can be security on security, that means there can be new financial instruments which are created on the existing financial instruments. Best example of this is futures and option contracts which are traded in the derivatives market. So, these derivative instruments are securities which derive their value from other securities. They have a form. With the introduction of depository institutions, investor can hold these securities in electronic form in depositories. Next comes the financial assets and instruments. So, it is an important component of the financial instruments market. So, these financial instruments, they enable channelizing funds from surplus to the deficit units. They are instruments for savers such as deposits, equity, mutual funds. There are fixed deposits, there are other banking schemes where you can deposit your money or in some instruments. There are instruments for borrowers such as loans, overdraft, etc. Like businesses, governments to raise funds through issuing of bonds and other treasury bills, etc. Instruments like PPF, Kisan Vikas Patra are available to savers who wish to lend money to the government. It can be in the primary market or the secondary market. So, talking about the services, the term services is very broad, which include a range of services from education, hospitality, tourism, healthcare services to various business and professional services. The Central Statistics Office CSO of Government of India has following grouping for the presentation of relevant statistics. It includes trade, hotels and restaurants. Second is transport, storage and communication, financing, insurance, real estate and business services, community, social and personal services, construction services. Talking about the financial services, it includes all activities which are involved in transformation of savings into investments. Financial services can be defined as those activities, benefits and satisfaction connected with the sale of money that offers to user and consumers finance related value. Financial services is one of the component of the total service sector in the economy. Financial services are delivered by the financial system of a country, the financial markets, financial institutions, regulatory framework and financial instruments. They make up the financial system in an economy. Body et al. Has defined financial system as set of markets and other institutions used for financial contracting and the exchange of assets and risk. The financial service sector or the financial system play a vital role in the resource mobilization and allocation process. The manufacturing sector needs the services of the financial service sector in the mobilization of capital, payment and settlement of funds, risk management, project financing and insurance. The term financial services includes services which are rendered by banking institutions, financial institutions, insurance companies and other institutions and intermediaries in the financial market. These include services such as portfolio management services, stock broking services, custodial services, depository services, leasing, retail financing, credit card services, credit rating services, factoring services. So, in the broad spectrum, financial services include banking, financial services and insurance, also known as BFSI industry. Now, the financial service sector can also be classified into two categories. It is fee-based services and fund-based services. Fund-based services are those financial services which include some transaction in terms of funds which are delivered from the financial institution to the actual consumer or the business who is their client. So, in a fund based service, there will be some money which will be transacted between the parties or will be lent by the financial institution to the other party. It includes leasing services, hire purchase services, bill discounting, venture capital, housing finance and insurance and factoring services. So, under the fund based services, wherever the funds are involved, so there are services like lease. So, lease financing is that particular service in which there is a lessor and he is giving goods or the assets which he owns on credit to the other party in a way that he can use it and he can pay some lease rentals on it. So, that is a fund based service. Hire purchases, when we buy goods on EMI, when that is also a fund based service and you have to, so ownership is transferred, but you have to pay in installments. Then there are bill discounting services where institutions who have their bills receivable, they get it discounted from some financial institutions like a bank or like any other non-banking financial company who is into the business of bill discounting. There is venture capital firms, which I already have explained, which includes those firms which are registered as venture capitalists under the SEBI Act and they are governed by SEBI norms. And the purpose of venture capitalist is to provide those funds funds to those entrepreneurs or businesses who are not able to get funding from anywhere else. So, they are basically financing the risky ventures. Housing finance is a very big industry where banks and other housing finance institutions, they are providing housing loan. So, it is also a fund based service. Then we have insurance services. So, insurance is giving you some sort of coverage in terms of any accident or any unforeseen circumstance which happens to you in terms of some financial. So, by paying some premium you can get insurance services, and that is very popular. Then there are fee based services which includes issue management. So, fee based services are those services where there is no money which is involved between the financial institution and the client or the customer. So, in a fee based service what happens is that the financial institution is providing you advice, is giving you guidance, is giving you consultancy in terms of how you have to go ahead with the projects in hand, or how you have to deal with various things which you are dealing with. So, this includes institutions or companies like issue management companies or portfolio management services. So, they provide issue management services which include that whenever an IPO will come or a public issue will come. So, they provide services like getting the advertisement done, or they become the lead manager for that IPO. So, that is the issue management. So, any public issue which is in the form of the primary market issue related to equity, related to debentures or bonds. So, they come under the issue management services which is handled by the investment banks or the merchant banks. Then there are portfolio management services for very wealthy clients. So, they provide they design portfolio for their clients in terms of how to invest their wealth in the best possible manner, so that they get the returns which they expect. Then there is loan syndication services. Loan syndication is that somebody is helping you get a loan sanctioned from any financial institution. So, for that you have to prepare a project proposal. So, if you are preparing a project proposal for your client and also giving some guarantee in case they need a guarantor for approving the loan. So, they are known as loan syndication services. Usually few financial institutions come together and they provide such kind of a service to big businesses. Then there are mergers and acquisition services. In case of merger and acquisition, when one company is acquiring another company or is merging with another company. So, they need to have some expert services of some person who is going to handle all the intricacies of a merger and acquisition. Capital structuring is when any company is trying to restructure their capital in terms of equity and debt, and what will be the overall proportion of equity and debt in their business. So, if they are going to change that equity and debt proportion or change their overall equity proportion, so that is capital restructuring. So, for that also there is advice which is given by investment banking firms or merchant banking firms. Credit rating agency, as I have already explained about it. So, credit rating agencies, they provide rating to companies and their funds or their financial instruments in terms of what kind of riskiness that particular instrument is carrying, what kind of returns you can expect from that particular instrument. So, that is how the rating is provided. There is stock broking services, which anybody who has to deal in the stock market, you need to get a demat account opened. And then you have to use the brokerage services of a stockbroking intermediary who is going to help you buy and sell the shares in the secondary market or in the primary market. Underwriting services are also provided by investment bank firms. So, in case of underwriting, they try to give you a guarantee that in case of a public issue or when a company is going for an IPO. So, if nobody is subscribing or buying to their shares, so they are going to they underwrite that we will buy your shares in case it is not fulfilling the minimum subscription norm. So, investment banks are majorly, or the merchant banking industry is majorly providing a lot of fee based services. So, two important players that deliver critical services in the direct credit market are investment banking firms and large money center banks. So, investment banks are those firms that specialize in helping business sell new debt or equity in the financial market. In addition, once the securities are sold, they provide a variety of broker dealer services like buying and selling of securities for securities that have already been issued. Money center banks are large commercial banks who who are major participants in the money market, these powerful banks are making the flagship bank for the economy and are providing funds and business loans to large multinational corporations. Bringing new securities to the market is one of the service of the investment bank. So, they help in the primary issue, and it is a 3-step process. In the first step is origination, where all the work necessary to prepare a security for sale is done. Second part is underwriting, where an investment banker is helping the firm to sell its new security issues to the directly to the financial market. And third is most common type of underwriting arrangement, that is called the firm commitment. In this deal, the investment banker assumes the risk of buying new securities at a guaranteed price. Finally, the distribution occurs immediately after the securities are bought from the issuer and is the marketing and sale of securities to the institutional and individual investors. So, talking about the nature of financial services. So, financial services are intangible in nature, they can only be availed, they are not visible, they are not tangible in nature, they can neither be displayed nor can be stored. Financial services are inseparable, these services are customer centric. So, customers are fully involved in the production of service, the services are tailored to suit the needs of the customers and require full involvement of the customers. Financial services are heterogeneous, they cannot be uniform for all clients. Services can vary from one customer to the other, they cannot be standardized, thus there are different formats for the marketing of financial services. Perishability, services cannot be stored, so once a service is availed, or you cannot save it for the next client, as and when the services are produced, the customer has to consume it, because services have to be delivered to meet the specific requirement of the customer. Advisory services. So, these services are advisory in nature, financial services are advisory in nature in case they are fee based services, for example, pricing of securities, private placement of shares. Another nature of financial services is that financial services marketing is a big area where you have a lot of job market, and these services need to be marketed. So, financial services are delivered through different channels of marketing. Some services are directly sold to the users, services such as insurance and mutual fund schemes are sold through the broker or direct agents. They are tech savvy. Financial services industry relies heavily on application of technology in its operations. So, delivery of services has become more efficient because of application of technology. There is large scale use of electronic modes of payment like NEFT, RTGS, mobile banking, internet banking in the country, and the government of India is encouraging such modes of transaction. Now, what are the characteristics of financial services? Financial services are intangible, heterogeneous, there is fluctuation of demand of these services, it is a labor intensive market. So, we require very skilled manpower in the financial service sector, and you can always understand that why the requirement of it is the biggest job market which exists in India nowadays. So, it is an information based service, it has requirement of skilled manpower, and it protects customers' interest as well. Some factors which have led to the growth of financial service industry in India, it is related to the reforms. So, Narasimhan committee recommendations have taken place, there are capital adequacy norms in place, non-performing assets norms are there, which have led to the changes in the Indian financial sector. There is opening up of insurance sector. Insurance sector earlier was not open to the private sector participation, but insurance laws bill in March 2015 marked a new era for insurance industry. There has been lot of growth in the capital market. So, number of companies which are accessing the capital market for funds have increased tremendously in last 2 decades. This has led to concurrent growth in the financial service sector. So, earlier it was only Bombay Stock Exchange, then National Stock Exchange was established, which was established as a electronic stock exchange, where all the transaction from an open outcry system converted itself to an electronic system of buying and selling of shares. After that, few more stock exchanges have been added. So, there is commodity market development, there are new kind of hybrid instruments of derivative market have come up, foreign exchange market has grown, Then there are electronic fund transfers is happening. RTGS and all those facilities have supported the electronic stock exchange market also. So, mutual fund industry is there, which and there are ETFs which you can buy and sell on the in the capital market through a stock exchange. So, a lot of developments in the stock market has taken place, because of which the stock market has increased in terms of volume, in terms of liquidity, it has increased in terms of the overall market growth, the turnover has increased, the amount of money invested in the stock market has increased many-fold over all these years, which shows that the faith of people or general public at large in the stock market has increased over years. There are non-banking financial companies which have gained importance over in last few years due to changes in the regulation of NBFCs. Number of companies who are operating as NBFCs have came down, and the amount of public deposit has also decreased. Strategic changes in corporate sector have taken place, like capital restructuring, mergers, demergers, takeover, share buyback are strategic changes that took place in the corporate sector. All these require various services of the merchant banks, who are key financial service providers in the financial markets. There are regulatory changes which have happened over a period of time. So, SEBI Act 1992 has provided the basic guidelines for participants in the financial markets. Investor protection and stability of the financial system were a top priority of SEBI, and overall these years there are a lot of developments and in the regulations that have come up in SEBI. Let us talk about recent trends in the financial sector. So, a lot of things have changed, and every day there are new kind of developments that are taking place in the Indian financial sector. So, talking about these, we all know that in 2008-10 there was a global financial crisis, also known as subprime crisis, with which whole world was affected, and it started in US and it has affected the whole world. There were many other collapses, many other bubbles which burst over all these years, which were a kind of financial crisis which have affected the economies of the country as well as growth prospect of all emerging economies. Financial convergence also has taken place. In US banking system, there is a concept of universal banking, which has been widely adopted in India also. So, all financial services are made available to customers under one roof in this model, and there has been financial convergence among various entities. So, if you go to a bank, so now there is single window dispersal of your request, which is possible in the universal banking system, and then one bank can provide a lot of services to you. So, there are subsidiaries of banks which are working as mutual funds, for they are providing insurance services, they are providing stock market services. So, multiple financial services you can find under one roof in one bank. Apart from that, financial inclusion has been possible because of the new government policies which have come up. So, that also is an important factor through which the banking system, if it is able to reach to every person of the country, then the reach of the banking sector will be global, and thus the reforms and the development which the government is planning to have can reach to every person in the nation. Financial engineering has taken place a lot. It means the development and the creative application of financial technologies to solve financial problem, exploit financial opportunities and to add value. So, they have taken place. Instruments like credit default swaps, collateralized debt obligations were introduced as risk management tools, but due to excessive speculation they have led to the collapse of financial institutions. Financial inclusion has happened. So, it is use of financial services by the population by bringing the poor and the underprivileged under the system of formal financial services. Financial reforms like Narsimham Committee recommendations, SEBI Act, launch of global depository receipts, and then there were reforms like the New Companies Act which has come. After that, there was corporate governance norms which have changed. There were corporate social responsibility regulations that have that keep on changing from time to time, and taxation system of the country has changed. We have adopted GST nowadays. There is Financial Stability and Development Council, which was set up by the government in 2010 to focus on the financial stability and financial sector development of the nation. There are Financial Sector Legislative Reforms Commission, which was set up in 2011 by the government to revamp the financial sector laws. Apart from that, there is International Financial Service Sector. The government has proposed to set up this center in Gujarat as a part of special economic zones. There is Insolvency and Bankruptcy Code 2016, which is one single law that will consolidate and amend various laws related to reorganization and insolvency resolution in a time bound manner. So, looking at all these developments that have taken place in the economy over all these years, we can see that the financial system of the country is growing at a very fast rate. As there are few facts which I would like to share here in terms of that being the financial service sector, it is the fastest growing sector in the economy and it is bringing the largest amount of GDP to the country. Apart from that, the financial service sector is not only growing, but the whole financial system is becoming strengthened and it is becoming more stable. With the kind of policies in last 10 to 15 years we have seen which are brought in by the government. So, government now understands that for the growth of any economy or for India to become a developed nation or when India wants to grow at a very fast rate, it is very important that the financial system is robust and there are all type of systems are set in place. So, one major development that happened was related to that when stock markets became electronic. So, that is one landmark development that has brought in. After that, derivatives were introduced in the stock market. So, introduction of derivatives have led to reduction in volatility in the market, have led to increased liquidity of stocks, have led to bring in more stability of the market, and then price discovery is also possible through derivatives market. So, that was one move where we are trying to converge with the best of the international standards which are available. So, ultimately, if India as a country will integrate with the with all other countries of the world, then they need to have they need to integrate in terms of all type of products and services that are available. So, in those terms we are doing very well in terms of the growth of the Indian financial system. Apart from that, after demonetization, you can see that there is a lot of increase in the online transactions of the by the people. So, lot of online payment channels are available and people are using more online method rather than using cash transactions. After that, GST came. So, GST also is a welcome move and it is also one way how we are trying to grow our whole financial system of the economy. Another important development that had took place is related to convergence to Indian International Financial Reporting Standards. So, IND AS that has been brought in is one way of converging to the international standards. So, I think we are doing really well in terms of growth of the Indian economy, and the country is surely going to bring in more trust, more stability, and we are going to in terms of investments from outside, India is doing really well. So, based on this, I would like to end it here as the introductory lecture. In the next lectures, we will talk about various other institutions like and markets like money market, banking sector and other institutions and services. Thank you very much.